To welcome back to the show, John Johnston, Executive VP, Chief Strategist, Davis Ray. John, first of all, I appreciate you finding time in the summer for us, but there's a ton to talk about.
Yeah, there is, and it's a pleasure to be here, by the way.
Well, I started the show talking about the new threat of auto tariffs, but of course we're in a trade sort of war environment right now, thanks to the president. And, it's just interesting or difficult, I think, also for investors to make sense of that. Should we be running for the hills or should we wait for an escalation? Can you put a little perspective on it for us?
Well, I'll do my best. This is not the kind of thing a lot of us are trained to process. Mm-hmm. And just as a starting point, and I'll give you some context afterwards, but I spent some time looking back at what happened in the post-World War I period leading up through the Great Depression, and tried to use that as kind of a framework for now. But right now, I'm inclined to think I'm very nervous about this whole trade thing, and I'm really concerned that we're unwinding the global order that has dominated my life and has generated so much wealth and opportunity in the world. And I'm worried that that's going into reverse. So I'm quite concerned about what's happening on the tariff front, what Trump is doing on a number of fronts, and I'm trying to build that into my forecasts. Right now, my assessment is that the whole trade side is basically throwing sand into the gears of the global economy, which means that it's not going to cause it to stop at the present time, but it's certainly going to slow it down. And the one thing I've been working with a long-term. One of the things I like to do is look at what I think returns are going to be over a 10-year period for equities. And one of the key things in that, and the most important thing in that, is what earnings growth is likely to be. And I tie my long-term earnings growth number to global nominal GDP. So I've got 2 to 3% real growth, 2 to 3% inflation. That gives 4 to 6% nominal GDP, which gives probably 5 to 6% earnings and dividend growth on a global basket of stocks, including emerging markets. Because of the whole trade thing, the way it's evolving, I'm keeping the 4 to 6 number, but I'm shifting the composition to maybe a half a point more of inflation and a half a point less of growth, reflecting the sand in the gears. And this whole globalization has worked to keep inflation lower than many expected. And I think if we unwind it, and I think we are going to unwind it to a degree, it's going to be a reverse supply shock, and it's going to add a bit to inflation. So that's what I've done so far. If we follow through on some of Mr. Trump's more extreme statements and some of the retaliatory threats coming out of the European Union and China, we then have to decide, is that changing the sand to gravel? And if we go from sand to gravel, it's going to have a more material impact on that longer run growth outlook and on the shorter term cyclical outlook. And if it gets really bad, that gravel becomes very rock-like, and it could cause a recession, or it could make a recession worse. Certainly when we look back at the history of tariffs, everybody says Smoot-Hawley caused the Great Depression. The Smoot-Hawley tariff came in the middle of 1930, when the world was already sliding towards a depression because of a global financial crisis. So it made it worse. And the Smoot-Hawley tariff came on the tail end of more than a decade of very high tariffs and rising tariffs across the globe in the aftermath of the First World War. It was so bad, in fact, that they had a number of global conferences, what we would now call G20 summits, to try to get tariffs down, and it didn't work. So we had a decade of rising tariffs before they really had an impact. And they had an impact on an economy that was being driven more by what was happening on the financial side. So they made the Great Depression worse. They didn't cause it. So I'm of the mind now that I'm not inclined to look for trade to cause a recession. There is a recession out there. I'm not exactly sure where it is, when it is. I don't think it's in the next 12 months. I'm more worried about rising U.S. interest rates. The U.S. Fed, for the time being, is still the most important central bank in the world. There's so many corporations globally, particularly in the emerging markets, that have borrowed in U.S. dollars. The rising dollar and rising U.S. rates are tightening global monetary conditions. And, the Fed always tightens until something goes bang. It's not always a recession. It can be a soft landing, but usually for investors, it feels like a bang because you get a bear market. And I think that's what's out there. And, you get the mix of rising U.S. interest rates, the mix of trade restrictions, and then you add some uncertainty in the Middle East and oil prices that are going up, not high enough on their own to cause a problem, but you mix them all together, and there's some issues off on the horizon there. So that's my take right now. And one of the things I have to confess is that I'm finding that when I look at the behavior of the global U.S. and Canadian economies and surveys of businesses and consumers, they show a lot less angst about trade than I'm feeling. I look at surveys of economists or economic experts and financial experts, and they're all they've gotten much more pessimistic. But the surveys of the people who are actually on the field making monetary decisions, spending decisions, are a lot more upbeat than us in the chattering classes, and I put myself firmly in the chattering classes. So I think that, that's something I've been pleasantly surprised by. So I'm feeling pretty good about the next 12 months. But, if something blows up, we have to reassess. But right now, the trajectory we're on looks decent for the next 12 months for economic growth, earnings growth, and not bad for equities.
We're going to take a break in a moment, so maybe we have to shelve some of this. But, the interest rate environment is interesting, obviously, with the U.S. raising rates, saying very clear signals they're going to do some more. We have the Bank of Canada raising, and that's the one that really impacts Canadians. I mean, whether we're talking about we've got $600 billion in some sort of consumer debt or $1.85 trillion in mortgage debt, with a good chunk of it having to be renewed, coming up in the next short while. I'm just interested in how the Bank of Canada move and what you see going forward on the interest rate front.
Well, I think the bank is generally acting appropriately, given the context I've given about trade and growth and stuff. So, and we want to get interest rates back to a level that's not at those very low emergency settings where market forces were prevented from working. I think we're now moving up to, we're probably now at a level where market forces are working and capital is being reallocated on a more efficient basis. I don't think it would hurt for the bank to raise rates a bit more as long as the economic and the risk environment didn't change. I certainly think that the Bank of Canada is not going to move nearly as quickly as the Fed is, and I'm kind of thinking that by the end of 2019, the overnight rate, which is 1.5% in Canada now, and that's the key rate for setting, that guides the prime lending rate from banks. I can't see it being above 2%. Maybe it gets to 2%. That would imply 2 more rate hikes. Where in the U.S., the Fed seems determined to get up towards 3% a year out. And just to add to your comments about the debt load, which I think is important, is that the Bank of Canada in its last few financial system reviews has been highlighting the role of home equity lines of credit, which have grown very materially, and those are the part of the lending composition for households where that reacts immediately to these Bank of Canada rate changes. And we all know that in a world of much higher debt loads, everybody's behavior is going to be a lot more sensitive to interest rates than in the past. So the idea of thinking about, the Bank of Canada thinks that a normal setting or a neutral setting for the overnight rate is 2.5% to 3.5%. I think that it's the level that's going to hurt us is below that because of the debt load, the debt in the system.
I'm talking with John Johnston. He's Executive VP, but he's Chief Strategist for Davis Ray. We'll talk a little more strategy. Just talking about interest rates there, that's a big one that with that much debt load, that high a debt load for most Canadians, that obviously has an impact. But the other one is the Canadian dollar. John Johnston, speaking of being a big fan, I'm a big fan of John Johnston's too. He's the Chief Strategist for Davis Ray. John, before the break, you gave us a little bit about, Canadian rates may bump up another 0.5 point, Americans moving faster. What are the implications for the Canadian dollar?
Well, as always, I learned the framework that the Bank of Canada uses to look at the Canadian dollar. And the key longer-term driver of the Canadian dollar is the basket of commodity prices, energy and non-energy. And I think that the economic environment I'm talking about for the next 12 months should be supportive for commodity prices. I know we're getting a bit of a correction in copper here. It's one of the few signs about these trade fears. But I think that the commodity price environment's pretty decent on net for the next 12 months. I think the monetary policy environment, which is the second factor of shorter-term movements, and shorter-term obviously is measured in months, not the market focus on very short term, but I think that these two factors together suggest a flat environment for the Canadian dollar. And I've had to downgrade my views a bit here, as my concerns about the trade environment, which I think are a negative factor for the Canadian dollar, has deteriorated. And I think that it's really not a risk factor anymore. It's a fact, and it's getting worse. And it seems like Mr. Trump is going to play the trade card ahead of the midterm elections because his base seems to really like it. So I think things are probably going to get worse before they get better. And so net, I take the offsetting commodity prices and Bank of Canada policy vis-a-vis the U.S. That's neutral. So flat Canadian dollar with a bit of a negative bias here over the next 12 months from the trade side. So, I'm kind of thinking maybe we get down to the 73-cent mark. We could trade, I think there's a range, but I think the trend within the range of, say, 72 to 78 cents is towards the 73-cent mark over the next 12 months.
My impression is that Canadians still don't understand how significant that is in terms of we just took a pay cut vis-a-vis the U.S. I hope we can compete with them when we're getting a 30% discount on our labor. And of course, anytime we travel into the States and, we import from the States, but that's why that's such a key number. Let me just, we've got a couple minutes left, so I want to broad base this a little bit. And obviously we're just talking generalities, but as the chief strategist, I'm just hearing here that, you're probably not jumping into the bond market,
No.
And you're not too uncomfortable with the equity markets.
Yeah, I'm not bullish per se, but when I look at where the equity markets are now, once again, there's two factors here. What's going to happen to earnings? And I think earnings are going to continue to grow. So that's a positive factor for equity prices. The price earnings multiple, how much people are willing to pay for each dollar of those earnings, has come down a fair amount. This year because of the softness in equity markets on net since early January. I think it's already building in a decent amount of bad news. And, we're not having a major, the last time we saw a big decline in equities was in 2015 into early part of 2016 when we were in the midst of a real significant global slowdown and an earnings recession. Right now, we still have strong earnings growth. The global economy looks okay. So I think for the next 12 months, earnings are good. Certainly suggests to me that as we go into 2019, I don't know that there's a lot of downside for the PE multiple. So I think maybe we could get some gains here in equities on a 6 to 9 month view. And so generally upward, not a roaring bull market, but upward, I think, after the correction we had earlier this year. On a 2 to 3 year view, I think we're late in the cycle. I think that the risk-reward is not incredibly favorable at this point in time, and I think that there is a bear market out there, but I don't see it in the next 6 to 9 months, just as I don't see an economic downturn in the next 12 months. Beyond that, it gets more questionable.
You got about 1 minute. Is there any groups you want to avoid, or ones you like especially?
Well, I'm kind of the view that Canada is going to get hit the hardest by any trade problems, so I'm kind of inclined to be outside of Canada, probably more so in the U.S. than anywhere else for the time being, despite the fact that it's more richly valued. I like cash, and I like short-term bonds, so like kind of anything 2 years and less. These rate hikes have made that a more attractive area, so kind of short-dated U.S. stuff out to 2 years. Including a lot of investment-grade stuff, which you can get 2% plus on that now. I like energy for the time being, and Canadian energy can do quite well. It's pretty cheap. The U.S. banks are very cheap. I think we're in a re-leveraging environment, but I think we just have to get over the flattening yield curve and wait for the Fed to send a signal that it's finished raising rates before we'll start to see that area perform well. But other than that, I like technology, but there's some government issues here, like what's going on in Europe. So I'm just being very careful. So energy in Canada and the banks in the U.S.